Hey, accounting scholars, welcome to the next section. We are now into section number 4, and we're going to start talking about some of the accounting recording events that occur in an accounting system. So, let's start with this question. What is the difference between journalizing and posting? Okay, again, this is more of a definitional vocabulary term, so make sure you get this definition in your notes. Journalizing is the process of recording an entire accounting event in the journal. When you have an accounting event, that, like making a major sale, you would record that in the journal, but then you would need to post that event to the various accounts. So posting is the process of recording the appropriate part of the accounting event in a specific ledger account. So when you make a sale, that could affect accounts receivable, that could affect cash, it could affect a variety of things, as we talked about in the prior video. So the journal is kind of the higher level document that records the major event, but then posting is the process of actually recording that to the appropriate ledger account. Okay, let's move on to the next area, which is the more DR and CR. This term DR and CR are just abbreviations for debit and credit. So in accounting terms, whenever you see the acronym DR or the acronym CR, that DR refers to debit and CR refers to credit. So if an account increases with a debit, what is the normal balance, a debit or a credit? And in this particular answer to this question, it would be considered a debit. Now, in the second question, what are the normal balances of assets, liabilities, and owner's equity? Typically, this is closely related to the accounting equation, as you might expect. An asset, when you increase an asset, there would be typically a debit or a DR to that particular account. Now, offsetting that would be entries in liability accounts and the owner's equity accounts, and in those cases, those would be considered credits. Credit to the liability account and a credit to the owner's equity account. And if you do that, then as shown in the accounting equation on this particular side, your assets will stay in balance and they will equal your liabilities and owner's equity. So again, the normal balance of an asset, a liability, and an owner's equity account would be and a debit to an asset account would typically result in a credit to the liability and the owner's equity account. So let's move on to the area of adjusting entries. So in adjusting entries, there are a variety of different kinds of transaction. They would typically reflect internal events, and they could be a revenue accrual, a revenue deferral, an expense accrual or an expense deferral. So what does that actually mean? A revenue accrual, as we talked about, would result in an increase in an asset. Example of a revenue accrual, as we did in the budgeting exercise, is if we sold coffee on credit, we would increase accounts receivable. A revenue deferral would result in a decrease in a liability. On the other hand, an expense accrual would result in an increase in a liability, and that makes perfect sense. Again, if you buy something and you pay for it on credit, that's in an accounts payable, and you would increase accounts your liability in accounts payable would increase. Now, an expense deferral would typically also be a decrease in asset. Okay, so those are adjusting entries. Let's move on to some examples of those. Actually, we're going to move through these very quickly, and just for review purposes, a revenue accrual is, in case you didn't get this in your notes, is an increase in asset. A revenue deferral is a decrease in your liabilities. An expense accrual is an increase in liability, and an expense deferral is a decrease in asset. Okay, let's talk about closing entries. Closing typically involves the end of a particular period, and what you are essentially doing is summarizing information, and in order to do that, you have to do some specific entries for that particular period. So in this particular case, you would zero out income statement accounts, and you would transfer their balances to owner's equity. An example of this is when we basically took the profit from the coffee business income statement at the end of each individual month, and we transferred that to retained earnings. So you would also debit your revenue accounts to close those out. You would all revenue accounts, you would debit those and credit retained earnings. You would close out your expense accounts by crediting those accounts and also debiting retained earnings. All right, so let's talk about the advantages of a computer-based transaction system. Most systems today, even for small businesses, most accounting transactions today are done on computers. I mean, most small businesses would use something called QuickBooks, which is probably the most popular accounting system in the world. So the traditional bookkeeping that is done in the past of manually recording individual transactions, are pretty much history, and that's why there isn't a lot of emphasis on necessarily on bookkeeping skills anymore. So the advantages of a computer-based system are basically three. Transactions are posted very quickly. You don't have to, you don't necessarily have to have a large series of journal entries. You can get listings printed out at any time, so you know exactly where your business is. You can get a variety of internal controls and edit checks to prevent and detect errors, and there's a wide variety of reports. And you can do this on a daily basis. I think I told you my cousin has a restaurant in the Napa Valley area, and in his first time around, he entrusted his books to his girlfriend's mother, and now she's living a fat and happy life somewhere on a beach in Mexico. And he ended up going bankrupt, but he got started again as any good entrepreneur. And when he started his next restaurant, he said, "I am going to do all the accounting," and he literally generates a set of income statements and balance sheets every day for his restaurant, and does it on a system which is a combination of Excel and QuickBooks. And more power to him. If you're an owner of a business, you should trust no one, especially as it relates to your money. And with knowledge of accounting and accounting systems, you are able to do that. All right, guys, we're going to end it there. Hope you have a nice night.